is Alan Nuckman, Chief Market Strategist at Agora Financial, live from the CME in Chicago. Now, Alan, moving into August, and usually it's the most volatile time of year, but not this time.
Well, it can be volatile. You've got to remember where we've come from. You know, we were at 50 back in February. The VIX right now is at the 11 handle. We've been trading roughly between 12 and 14 for 3 weeks, almost a full month now. We had a fake out breakout last week where it rallied up to 1450 on Thursday and then actually closed lower. So last week, net, the VIX ended up losing 10%. So we still are in a downward trend in the VIX and an upward trend in stocks, now within striking distance of those all-time highs in the S&P that we haven't seen since January 26th.
So what do you attribute this to? Is it sort of complacency on behalf of the market, or is it just that we don't have any real clarity on the trade tensions and all of these things, so we're just piling into the market and feeling calm until we get another tweet?
Well, the markets haven't reacted terribly negatively over the long term to these tweets and these policy prognostications. You see short-term volatility, but in the big picture, you know, we're still on a long-term downward trend. Let's remember that the extreme low is down below 9, so we still have some more downside to go, just like I believe we still have more upside to go in stocks. So I wouldn't say that we're complacent. We're still a good percentage off that low, so that means there's more downside in the VIX, but we get these flare-ups from time to time. Then it's important to see how the markets react, and last week was another great example of that. We've seen a series of lower highs on a weekly basis, and last week when we did pop up, they smacked it back down once again, and we can see we are in a bull market no matter how you look at it.
Well, we are, that's your words, and of course the S&P 500 agreeing with you, climbing for the fourth time in the last 5 sessions. Are we going to get above the all-time highs? Right. They're not far away, 30 or 40 points away.
Yeah, I thought we'd be there by the end of July. Didn't quite happen yet. We've got, again, these tariff tantrums that come in and out of the market. But in the overall, the market is moving past that. And you've talked about earnings. That's what's driving this market's fundamental facts. And we've had 80% of S&P companies report, and 80% have beat their EPS, and 75% have beat their revenue. So extremely strong numbers. And the growth rate for this quarter is around 24%. So we're getting 2 back-to-back quarters with growth of over 20%. So nobody in corporate America has anything to complain about when you look at that kind of performance, and that's what's driving the stock market. If we look in the big picture, the S&P had been trading between 2,600 and 2,800, so that breakout above that 2,800 targets 3,000. That's still the upside objective, and you know, that's the way I'm going to position myself, remain bullish until proven otherwise, and the market has bounced back each and every time.
So if the market's basing it all on earnings, facts if you will, how do oil supply concerns play into this? I mean, we see the Iran sanctions about to kick in now. There's a few other supply concerns.
Right.
Could that affect the earnings and therefore the facts of the matter and therefore the market?
Well, oil's been on an upward trajectory as well, moving up for 4 years, and we're holding around the $70 level for West Texas Intermediate crude. Moved to the new highs, to the highs from a couple weeks ago at 73, targets 80. And now that puts us right at the halfway point. We're at 75 is about the halfway point of the action from those recent extreme highs to those lows down below $30. So we've gotten back half of that big move. So I still see more upside, and I look at oil as a barometer of overall global growth. And I look at that as a positive sign as you see oil continue to trend upwards because world economies are expanding, and as does their consumption. What happens in Iran could be more symbolic than anything. They sell their oil elsewhere, so it's not an American issue. But I think that they had some military exercises in the Strait of Hormuz that, you know, got people start thinking again. There used to be a time not so long ago, 3, 4, 5 years ago, when geopolitical tensions put some risk premium in the oil market. That's been taken out. But there's always price shock potential because that could be a bottleneck. Just like even with this extreme production here in the United States, we're having a problem with distribution as well. So, you know, sometimes you have too much oil and you can't get it to where you need to go, and that can slow down the markets and boost prices once again.
If oil prices move too much up, you know, it may cause a little bit of tension there. And I just want to see what your gauge is on the elections coming up later in the year, and if the Democrats claw back a little bit of power. I mean, what does that do to volatility and uncertainty?
At this point, politics, I try and completely factor that out of the equation and just look at the price. The price has remained strong. Let's remember we're in a 9-year uptrend in the stock market of almost straight up of a couple 100%. And until the equation changes and interest rates rise, where you have a choice between the stock market and yield and treasuries, there is no choice. And the stock market's where money is going to flow. So right now, let's put the politics on the back table, because you would think of all the things that happened politically this year that should have shaken the market, and it hasn't. So it's more important sometimes what the market doesn't do than what it does. And in this example, for the market to be this close to all-time highs after what we've been through in the last 6 months has to be very, very impressive. And you have to remain bullish with what we've seen.